Hello friends, welcome to my YouTube channel at One Raj Kamal. The last week was a pretty good one for markets with all major indices showing bullish candles. S&P 500 was over 1.9%. Dow Jones went up by about 0.8% and Nasdaq was the strongest performer of them all, growing over 4.5%. And this was after a pretty bearish last week. The growth in all major indices was probably driven by a decline in 10-year yields that came down from 3.48% in mid-June to around 2.8% by 5th of July before rallying back up to 3.08%. So it's potentially a relief rally and driven by decline in 10-year yields, and that's what you see with the sharp increase in Nasdaq, which is the most sensitive to 10-year yields. Also, this may be driven by decline in commodity prices that may signal that inflation is coming down. See this chart, which shows second quarter futures performance across commodities, be it oil, natural gas, copper, lumber, wheat, corn, cotton, soybeans. All of them are showing declines. And this may signal that demand is cooling off. And with the cooling off in demand, the sky high prices that were happening in all commodity prices would then begin to turn around and come down. And that would mean that the Fed may not require to be continuing on its very hawkish monetary stance. Now, is this sustainable? Well, if you look at the S&P 500 daily chart here, you can see that S&P 500 is in a downward trend since the beginning of this year. See those two red lines, which are showing a downward trend. And you can see that we are consistently seeing lower highs and lower lows since the beginning of this year. This trend needs to be broken before we can turn any rally to be sustainable. But even if this trend is broken, it may also be an example of a bear market rip-in-your-face rally driven by a sharp pullback. This is because there are other major economic headwinds. The jobs report that came out on Friday was very strong, even after the negative revisions of the past couple of months. The JOLTS report that you can see over here shows steepening job openings, growing hires, and declining layoffs and discharges. In fact, in the US today, there are 2 job openings for every hire currently. Now this strong job market signals that there is no reason for the Fed to change course and get away from a hawkish monetary policy stance. This is actually witnessed by looking at the CME Fed Watch tool, which shows that there is over 90% probability of a 75 basis points rate hike in July. So if the Fed is going to continue on its tight monetary policy path and increase rates and continue to shrink its balance sheet, then liquidity will continue to go down. And in a declining liquidity environment, a strong rally or a sustainable rally in the markets is questionable. Now, next week, everybody will be most likely focused on CPI and PPI numbers. But in my view, earnings report that begin to come out next week onwards are actually the real piece of new information that the market will get. Now, earnings estimates haven't come down significantly. The best place to look out for earnings estimates are actually an Excel that Howard Silverblatt, an analyst at S&P, comes out with on a regular basis. And if you look at his Excel sheet as shown over here, you can see that the expectations for Q2 earnings are higher today at 54.84 than what was at the end of December 2021 when it was 54.35. So higher today for Q2, in spite of all the economic headwinds that we've seen in the last 6 months. And this is true for even Q3 and Q4, which are actually much higher than today than what was the expectation in December 2021. Now, the reason why it is like this is because most companies haven't done any downward revisions in their earnings outlook. Yes, there have been a few like Netflix, but very few, and not the major ones, not the really big ones that impact S&P 500 in a major way. As a result of this, the price to earnings picture for 2022 forward looking has come down from above 21 in December to about 17.46 currently as the markets have collapsed. If you look at this chart, you can see that the price to earnings number seems to be coming in line with what has been there over the last 5 years. So prima facie, things may be looking fine and fairly valued. However, if the economic headwinds haven't translated into earnings revisions, this number may see a bounce back as earnings estimates are revised in the coming earnings season, and that may mean that there are still more ways in which the market may fall, and it is not fair to say that the worst is behind us. Overall, in my view, earnings are the real piece of new information that the market will get starting next week. I believe that the markets will continue to be choppy till about October this year, and only beginning November and heading towards the end of the year will the markets show any strong tendency to rally and any sustainable rally. Till then, I think markets will continue to trade sidewards. Thank you for joining me today. You can subscribe to this channel by clicking on the bell icon, and you can follow me on my Twitter and Instagram handles at Raj Kamal. Thank you.